Professional ethics form the foundation of the auditing profession and are essential for maintaining public confidence in assurance services. The primary objective of the Code of Ethics and Conduct is to ensure that professional accountants act in the public interest by maintaining integrity, independence, objectivity, and professional competence in all business relationships. Since users of financial statements rely upon the auditor's opinion when making economic decisions, ethical conduct is fundamental to the credibility of financial reporting and capital markets. The Code adopts a principles-based conceptual framework, requiring accountants to identify ethical threats, evaluate their significance, and apply appropriate safeguards to eliminate or reduce them to an acceptable level through professional judgment rather than rigid compliance with prescriptive rules. The Code establishes 5 fundamental principles that govern the behavior of professional accountants. Integrity requires accountants to be straightforward, honest, truthful, and fair in all professional relationships, avoiding any association with misleading information. Objectivity requires professional judgment to remain free from bias, conflicts of interest, undue influence, or inappropriate reliance on others. Professional competence and due care require accountants to maintain appropriate technical knowledge through continuous professional development and perform all assignments diligently in accordance with current professional standards and legislation. Confidentiality obliges accountants to protect client information, prohibiting unauthorized disclosure or personal use unless a legal or professional duty exists. Finally, professional behavior requires compliance with relevant laws and regulations while avoiding any conduct that may discredit the profession or undermine public confidence. Together, these principles establish the ethical standards expected of all members and auditors. The conceptual framework recognizes that compliance with these principles may be threatened by various circumstances encountered during professional engagements. The framework therefore requires accountants to identify threats, evaluate their significance, and determine whether safeguards can reduce them to an acceptable level. If appropriate safeguards cannot be implemented, the engagement should be declined or discontinued. This principles-based approach provides flexibility for dealing with emerging ethical issues while emphasizing professional judgment and responsibility to act in the public interest rather than merely complying with minimum legal requirements. 5 categories of ethical threats are particularly relevant to audit engagements. A self-interest threat arises when financial or personal interests influence professional judgment, such as excessive fee dependency, share ownership in the audit client, or acceptance of significant gifts and hospitality. A self-review threat occurs when auditors evaluate work that they previously performed, for example providing accounting records or valuation services that subsequently become subject to audit. An advocacy threat arises when auditors promote a client's position to the extent that their objectivity may be compromised, such as representing a client in legal disputes or investment promotions. A familiarity threat develops through close personal relationships or long association with management, reducing professional skepticism and independence. Finally, an intimidation threat occurs when auditors face actual or perceived pressure from clients, including threats of dismissal, litigation, or fee reduction designed to influence audit conclusions. Safeguards are actions or measures designed to eliminate ethical threats or reduce them to an acceptable level while preserving compliance with the fundamental principles. Common safeguards include assigning independent engagement partners and review teams, rotating senior audit personnel, obtaining independent quality reviews, segregating audit and non-audit service teams, removing financial interests, declining inappropriate gifts or hospitality, consulting technical specialists, strengthening firm quality management procedures, and providing ongoing ethics training. Where conflicts of interest arise, separate engagement teams, confidentiality barriers, restricted access to information, and informed client consent may be necessary to protect confidentiality and objectivity. If safeguards prove insufficient, the audit firm should decline or terminate the engagement to preserve independence and professional credibility. Auditor independence is both a state of mind and a matter of public perception. Independence requires freedom from relationships or circumstances that could reasonably be perceived to impair objectivity by an informed third party. Auditors must therefore avoid financial interests in audit clients, inappropriate business relationships, excessive fee dependency, close personal relationships, and management responsibilities that compromise independent judgment. Conflicts of interest may arise where the same firm acts for competing organizations or parties involved in the same transaction. In such cases, the nature of the conflict should be disclosed, informed consent obtained where appropriate, and confidentiality safeguards implemented. Where conflicts cannot be adequately managed, the engagement should not be accepted or continued. Confidentiality represents another fundamental ethical obligation. Auditors possess extensive access to commercially sensitive information and must not disclose client information without proper authority except where disclosure is required by law or professional duty. Disclosure may be required in cases involving fraud, money laundering, tax evasion, terrorism financing, regulatory investigations, or court proceedings. Before disclosure, auditors should consider the reliability of available evidence, potential harm arising from disclosure, the appropriateness of recipients, and applicable legal obligations. In certain circumstances, disclosure may also be justified in the public interest where failure to disclose could expose stakeholders to significant financial or physical harm. Where breaches of the Code of Ethics or independence provisions occur, auditors must act promptly to address the consequences and restore compliance. Appropriate actions include ending or removing the relationship causing the breach, informing the engagement partner and ethics function, assessing the significance of the breach, performing additional independent reviews where necessary, considering notification to or regulatory authorities, and evaluating whether continuation of the audit engagement remains appropriate. If the breach cannot be satisfactorily mitigated, the auditor should communicate with those charged with governance and withdraw from the engagement where required. Prompt identification, evaluation, remediation, and reporting of ethical breaches reinforce audit quality, preserve professional integrity, and maintain public confidence in the auditing profession.